In this informative video, we dive deep into the recent interest rate cuts by the Federal Reserve and explore their potential impact on your personal finances and savings. Interest rates play a crucial role in the economy, influencing everything from consumer spending to business investments, and understanding these cuts is essential for making informed financial decisions. We begin by explaining what interest rate cuts are, breaking down how the Federal Reserve's decisions can ripple through the economy and affect borrowing costs. You'll learn how lower rates can lead to cheaper loans, making it more affordable for homeowners to secure mortgages, for students to take out education loans, and for individuals to obtain personal loans. This segment will help you understand the broader implications for your monthly payments and overall debt management. With interest rates decreasing, many savers may notice a decline in the interest earned on their deposits. We'll discuss strategies to maximize your savings during this time, including exploring high-yield savings accounts and other investment options that can offer better returns. In addition, we provide insights into how to adjust your investment strategies in a low-rate environment. With traditional savings yielding less, it may be time to consider diversifying your portfolio or exploring alternative investments that can potentially provide higher returns. We'll cover key investment principles to keep in mind as you navigate this changing financial landscape. When the Federal Reserve decides to cut interest rates, it sets off a chain reaction that ripples through the entire economy, touching every aspect of our financial lives, from the money we save to the loans we take out and the investments we make. To understand this impact, we first need to grasp what Fed interest rates are and how they function in our economic system. The Federal Reserve, often simply called the Fed, is the central bank of the United States, and one of its primary tools for managing the economy is setting the federal funds rate. This rate is the interest rate at which banks lend money to each other overnight to maintain their required reserves. While this might sound like a technical detail far removed from our daily lives, it's actually the foundation that influences almost all other interest rates in the economy. When the Fed lowers this rate, it's typically trying to stimulate economic growth by making it cheaper for banks to borrow money, which in turn makes it cheaper for businesses and consumers to borrow as well. This lower cost of borrowing is intended to encourage spending and investment, which can help boost economic activity. However, the effects of these rate cuts are far-reaching and can impact different aspects of your financial life in various ways, some beneficial and others potentially challenging. Let's start with how these rate cuts affect your savings. When the Fed cuts rates, banks generally follow suit by lowering the interest rates they offer on savings accounts, certificates of deposit CDs, and other savings products. This means that the money you have tucked away in your savings account or emergency fund will likely earn less interest, potentially growing more slowly over time. For many savers, especially those who rely on the interest from their savings for income, this can be a significant concern. However, it's important to remember that even in a low-interest environment, maintaining a robust emergency fund is crucial for financial stability. To mitigate the impact of lower savings rates, you might consider shopping around for the best available rates, as some banks, particularly online banks with lower overhead costs, may still offer relatively competitive yields. High-yield savings accounts or money market accounts might also be worth exploring, as they typically offer higher interest rates than traditional savings accounts. While the returns may be lower than in high-interest environments, these accounts can still provide a safe place for your money with some growth potential. Moving on to the impact on borrowing, this is where rate cuts can potentially work in your favor. When it comes to mortgages, lower Fed rates often lead to lower rates on new fixed-rate mortgages. If you're in the market to buy a home, this could mean more affordable monthly payments and potentially the ability to afford a more expensive home. For those who already own homes, a rate cut might present an opportunity to refinance your existing mortgage at a lower rate, potentially saving you thousands of dollars over the life of your loan. Adjustable rate mortgages ARMs may also see lower payments, although it's important to remember that these rates can go up again in the future. Auto loans are another area where you might see benefits from rate cuts. New car loans may come with lower interest rates, making your monthly payments more affordable or allowing you to afford a more expensive vehicle. If you already have a car loan, you might want to explore the possibility of refinancing to take advantage of the lower rates. Credit card debt, which typically carries high interest rates, may also be affected by Fed rate cuts. Many credit cards have variable interest rates that are tied to the prime rate, which tends to move in tandem with the federal funds rate. As a result, you might see your credit card interest rates decrease. However, It's important to note that even with a rate cut, credit card interest rates are still typically much higher than other forms of borrowing, so it's always a good idea to pay off credit card debt as quickly as possible. When it comes to student loans, the impact of Fed rate cuts can vary. Federal student loan rates are set differently and won't be immediately impacted by Fed rate changes. However, if you have private student loans or are considering taking out new ones, you might see lower rates available. This could also be an opportunity to consider refinancing existing private student loans to potentially secure a lower interest rate. Shifting our focus to investments, Fed rate cuts can have complex and sometimes counterintuitive effects. In the stock market, lower interest rates are generally seen as a positive factor for stock prices. This is because lower rates make it cheaper for businesses to borrow money, which can lead to increased investment, expansion, and potentially higher profits. Additionally, when savings accounts and bonds offer lower yields, some investors may shift their money into stocks in search of better returns, driving up demand and prices. However, it's crucial to remember that the stock market is influenced by a multitude of factors, and the impact of rate cuts alone doesn't guarantee positive performance. The bond market, on the other hand, has a more direct and predictable relationship with interest rates. When rates fall, the value of existing bonds typically rises because their interest rates become more attractive compared to new bonds issued at lower rates. This can be good news if you already own bonds or bond funds. However, if you're looking to buy new bonds or invest in bond funds, you'll likely see lower yields, which means less income from your bond investments. Real estate is another area that can be significantly impacted by interest rate cuts. Lower mortgage rates can stimulate the housing market by making home ownership more affordable for many buyers. This increased demand can drive up home prices, which can be beneficial for current homeowners, but challenging for those looking to enter the market. From an investment perspective, real estate investments might become more attractive due to lower borrowing costs, potentially leading to increased activity in both residential and commercial real estate markets. For those with retirement accounts like 401ks or IRAs, the impact of rate cuts will largely depend on your specific asset allocation. If your portfolio is heavily weighted towards bonds, you might see the value of your existing bond holdings increase, but future bond investments may offer lower yields. If you have a significant portion of your portfolio in stocks, you might benefit from any general uptick in the stock market that often follows rate cuts. However, it's important to remember that retirement planning is a long-term endeavor, and it's generally not advisable to make drastic changes to your investment strategy based solely on interest rate movements. Given these wide-ranging impacts, it's natural to wonder about the best strategies to adopt in a low-interest rate environment. One of the most straightforward approaches is to take advantage of lower borrowing costs by refinancing high-interest debt if you qualify for better rates. This could potentially save you significant amounts of money over time, especially on large, long-term loans like mortgages. If you're in the market for a major purchase like a home or a car, a low-interest rate environment might provide a good opportunity to secure favorable financing terms. However, it's important to consider all factors, not just interest rates, when making such significant financial decisions. When it comes to saving and investing, the strategies can be more nuanced. While it might be tempting to pull money out of low-yielding savings accounts in search of higher returns elsewhere, it's crucial not to neglect your emergency fund and other short-term savings goals. Financial security should always be a priority, even if the returns are modest. For longer-term goals, you might need to reassess your investment mix based on the new rate environment.